Okay, welcome back. Just kind of sort of running into the pre-open, the SGX indicating a 80-point downtick. Deepan, of course, is still with us, but Anuj is here with us in the studios as well. Anuj, how are things looking?
Morning, Prashant. It's a bit of a global versus local sort of view that we have. Global worries, US market down, but exit polls clearly cheering the market. The interest rate worries are back in the market. So my sense is that the reversal that we had in the trade will reverse again, in the sense that IT will start to underperform once again and banks may start to outperform. That is an algo trade which could play out. In fact, now, if you'll also have an eye on what happens with the monetary policy tomorrow. But as I said, Bank Nifty may outperform. Today is also Financial Nifty's weekly expiry, and that normally has an impact on the Bank Nifty on Tuesdays. That's the most traded instrument as well, the Financial Nifty. Brent's decline, I think, is also another factor which could help Bank Nifty. So today, you might have an algo trade where initially you see the Bank Nifty outperform. On the Nifty, it could be a bit of an inside day today. Yesterday's high and low, important to watch. High was 18,728, low was 18,591. So that could be the range. I'll keep an eye on the Nifty IT to see if that shows further weakness or starts to recover. If it starts to recover, perhaps even the Nifty recovers. But as I said, today focus on the Bank Nifty. It's actually now very close to its all-time high. And my sense is that it could actually make a move towards all-time high. The Indian market has been ignoring sort of global cues. And today, maybe it's no different. The gap down could well be lapped up by the bulls, especially on the banks.
Okay. In fact, thanks a lot, Anuj, for that. I wanted to take that question forward with Dipan as well. Dipan, I know it's a bit of a crowded trade now, what's happening with the banks. But ICICI Bank at its analyst day was very confident. I mean, they spoke about increasing their core operating profits further and, how their philosophy has changed under the leadership of Sandeep Bakshi, how things are expected to improve further. Do you see this re-rating that ICICI Bank has gotten? Do you see it continue? I mean, are there more legs to this rally here?
Absolutely, Sonia. I think ICICI Bank is becoming like a must-own stock in the portfolio if you're benchmarking against the Nifty and Sensex and you expect to outperform those indices. And clearly, I think all the past troubles are well behind them. Change of management has made a huge difference to the company. There's value being created in the subsidiaries, and overall lending standards have improved and they become more aggressive in the marketplace. And while a lot of investors are concerned about uncertainty around HDFC Bank merger, and conservative approach of Kotak Bank, I think ICICI Bank first and Axis Bank after that. Clearly, I think they blend aggression with a good degree of responsible lending. And you could expect them to start trading at premium multiples, if not already, compared to some of the other large cap private sector banks.
Okay, all right. Dipan, later in the show, we're going to be talking about the cement names. And some of them had a good pullback from the recent lows. Pricing is going up. Demand, I believe, was good in the month of November. But input costs as well have cooled off. What's your sense on this space? You want to avoid it, I think.
Yeah, Nigel, I want to avoid all materials at this point of time. And there are so many ideas in material consuming companies. I mean, real estate, engineering, construction, which consume cement. I think they have better prospects than cement at this point of time. And there's just always this hanging sword about overcapacity within the sector, considering the structural changes which are taking place with the entry of a very aggressive player with very deep pockets. So you have to account for these changes taking place within the sector. And the capacity of the companies to pass on cost increases is definitely reducing. We have seen that in the last 2-3 quarters or so, when their operating profit margins have been completely crushed. So I would like to avoid cement at all cost.
Okay, avoid cement at all cost. Got that. Well, this is our momentumizer segment. So although today the market will open in the red, but there are some stocks which are moving with good momentum on the upside. And Vivek is joining us. He has one of them on his list. Vivek, what are you looking at?
Well, good morning. Stock from the pharma universe is the one that we are tracking. So Strides Pharma is the stock in focus. And yesterday, this particular stock moved up strongly on high volumes. The NSE delivery percentage was a little over 29%, so good percentage there as well. And technically, if you're looking at the key DMAs, the stock is comfortably trading above all three of the key DMAs, the 50, 100 as well as the 200 DMAs. Now, just looking at the price action in the last couple of trading sessions as well as the last month. Now, this particular stock has gained for 4 straight sessions, and also in the last 7 sessions, the stock has gained for 6 out of the last 7 sessions. The stock from October 2022 lows actually is up almost 25%, and 21st October is when this particular stock saw a sort of a bottoming out. Since then, it's seen a very sharp up move. The 52-week low for this particular stock is at 263, and the 52-week high that just a couple of months back was at 497. The stock again is moving upwards, so that's why it's hit the momentumism segment today.
Okay, thanks a lot for that. Well, Dipan Mehta is still with us. Dipan, wanted your thoughts on a company and a bank that we'll be talking to in just a while from now, J&K Bank. Now, I know asset quality issues have been persisting for a while, but this stock has had a big move over the last many months. Any thoughts on this one?
Well, Sonia, I think it is cheap, and largely I think PSU banks and old private sector banks like J&K, they have a good runway for the next few quarters or so. The NPA cycle has not picked up. There's good demand for credit, and even fee-based income should go up. Operating leverage should come into play. So I think intuitively, I feel that J&K Bank can continue to outperform. But as I said, when things start to turn awry, J&K Bank, M&M Finance, all these weaker players which got into a mess in the last NPA cycle, I'm pretty certain that they'll get into a situation and a problem again as well. So, when the party stops, one doesn't really know, but that's the time when the problems start to come up. And then sometimes these companies don't even provide an exit to investors. So I'm a bit careful on that count.
Okay, all right, Dipan, thanks so much for stopping by, giving us your view on a whole host of stocks and sectors. Wishing you a good day ahead. But I think you want to hang on a little bit. We're talking to the management of Jammu and Kashmir Bank. So tune into that conversation. Well, they saw a mixed set of numbers, actually, the bank in the second quarter. The net interest margin, well, that was aided by yields. The loan growth has come a little lower than what the industry was working with, and slippages remain elevated. But to understand what's causing this big move, in the last 6 months, the stock is up. You pull up the last month and even 3 months, the stock has moved one way. That's up. So let's understand the fundamentals. We are joined by Mr. Baldev Prakash, the MD and CEO at the bank. Hi, Mr. Prakash. Morning. Thanks so much for joining in. Well, let's get a couple of numbers out of the way. One is, what is the loan growth you're looking at for this year itself? Some part of the street believes it could be high teens. Could you tell us what is your target? And also your NIMs at around 4%. Well, it's been aided because your deposit franchise is quite strong in the state of Jammu and Kashmir. So can you hold on to this number? Loan growth and NIMs. Go ahead.
Yeah. So thank you so much for having me at your show. See, as far as loan book is concerned, the bank is looking at around 16 to 18%. And in the best case scenario, around 20%. And the focus, of course, remains in J&K, and Ladakh is mainly on the retail growth. We have a very good franchise in the shape of government employees and the police personnel. There we have already provided them the facility of digital loans. We call it phone pay loan. And that book is holding very good. Hardly any delinquencies are there in that book. As far as the rest of India is concerned, we are mainly focused on high-rated corporates or public sector units, public sector undertakings. And with this mixed strategy, I think we will be able to bring this around 17-18% of overall growth in the loan.
What about NIMs? NIMs, sir? NIMs are around 4%. Can you hold on to this?
Yes, NIM is around 4%. We are confident we will be able to maintain this around 3.75 to 4%.
All right. Mr. Prakash, good morning. Good to have you with us here. The state, of course, depends heavily on tourism, right? And that has kicked off in a huge way over the last couple of years. Ever since, of course, I mean, the reclassification as a union territory, etc. Just a quick word on, you just divide the loan book for us. You said government employees is a big one, and otherwise, but what's the book division in a more granular way right now, and how do you see this progressing?
Yeah, so Prashant, 85%, around 80 to 85% loan book is mainly concentrated in J&K and Ladakh. That is entirely retail loans and agriculture, of course. And around 20% of the total loan book is with the government employees and police personnel of J&K government as well as Ladakh administration. And as far as the rest of India, we call it rest of India means out of J&K and Ladakh.
Okay.
That loan book is growing now, and we are confident that we should be able to take this book to around say 40 to 50%.
This is government employees. 20% is government employees.
Yes, total 20% is with the government employees,
Okay,
where the phone
Got
pay
it.
loan, that is a digital loan.
Got it.
Okay.
The rest of the 85%, what is the, which you said this is retail and agri, but could you tell us what kind of loans are these? I mean, for these very small establishments, but just a bit more granular detail, sir.
Yeah. So we have this retail book is mainly related to home loan, housing loans, and the agriculture and MSME, small MSME, mainly in the state of J&K and Ladakh. And the corporate book, which comes from the rest of India portfolio, is high-rated corporates, that is AAA rated and above, AA rated and above, and the public sector undertakings. That is the basic, the size of the book.
Okay. Mr. Prakash, good morning. I wanted to talk a little more about asset quality because although your asset quality has improved, your slippages are still quite elevated. And you did mention that a chunk of your business comes from government employees through the digital loan space. Is it fair to assume that the gross NPAs will improve further over the next few quarters? If yes, what is the level that you're looking at?
Yes, Sonia, we had this quite elevated NPA book of around 9%, as you know, in the last few quarters.
Yes.
But the team is working now very hard on NPA, and we have around 7.5% of NPA as of now. And the way we are working, I'm confident that we should be able to bring this NPA book to around 6% by the end of the financial year.
Okay, so 6% by the end of FY23 is where your gross NPAs will come
Yes,
to?
yes, that is what our target is, and already high value NPAs we are working on it and quite on advanced stage, and hopefully we should be able to resolve that.
And on the slippages, you're sitting on an average of around 1,800 crores. Just trying to understand how much could you bring that down by, and have you seen, if you've seen an improvement, which I'm sure you have, considering you're bringing down your NPAs, which pocket has it come from?
So this slippage, Sonia, was mainly relating to the government employees' accounts, where one account slipping is taking 2-3 accounts like home loans and other car loans, etc. So that has been fixed with the support of technology now. We have inbuilt NPA tracker, and we are confident that that issue is now passed, and we are confident that we will be able to maintain this slippage ratio less than 5%.
Okay, all right. Mr. Prakash, final question before we let you go. Your return ratios, that's the ROA and ROE. The street is quite optimistic that you can take that. Case in point being the ROE, maybe they can take it to mid-teens. Do you believe so? Give us a guidance on that front.
Yes, so ROE right now is around 14%.
Yes.
And the target for us is to take it to around 15%.
Okay, and ROA?
ROA, we are at around 0.75%. The target is to take it to around 1%.
Okay, and very quickly, since the stock price has gone up in this manner, do you require to raise any kind of equity?
So, board has already approved the raising of capital of Tier 2, that is 1,500, and Tier 1, 500 crores. And we are confident we will be able to raise the Tier 2 during this quarter. And the next quarter, we are targeting 500 crores of Tier 1 capital.
Okay. Right. Mr. Prakash, thanks a lot. We'll leave it at that. Thanks for joining in. That's J&K Bank. Dipan Mehta is still with us. Some very interesting takeaways over there, Dipan. He's saying that, government employees now, things are picking up. The asset quality is becoming better. They have digital loans are picking up. They have a tracker for NPAs. So getting technology savvy here, a lot of these banks. You think a lot of it is in the price, or is there more to go?
So as I said earlier, that these companies should do well when the economy is doing better, the region is doing much better, and J&K, of course, has a very good position within a very important state. So I'm sure it will do well. But as I said, I'm not yet convinced about their ability to handle the storms which keep coming from time to time every few years in the banking sector. So I think it's a good trading bet, but I'm not sure about a 3 to 5 year type of a view on J&K Bank. And lastly, Sonia and the entire team at CNBC, I want to take this opportunity to wish congratulations on completing 23 years. It's been a privilege to be associated with you. You've helped create public opinion and have been a friend, philosopher, and guide to millions in their wealth creation journey through equity. So kudos, congratulations. It's been really a fantastic journey, and keep up the good work. That's all I can say. Thank you.
Thank you so much. Yeah.
That's a lovely message, Deepan. Great to hear that, and thank you very much for being with us. We of course bounce off questions to you, and so that's the medium which has worked beautifully. Thank you very much once again, and
Thank you.
appreciate it.
I just want to say that this brand, right? I mean, that all of us are a part of, has facilitated so much for us in terms of we being able to reach out to our viewers, our investors, retail audience reaching out to us. I remember 2 years back when I started that, investor education show, Smart Money. At that time, there were so many people had so many questions, and we tried to answer that. And with that, I was able to learn every single day. So I'm so grateful as well, since Dipan was just pointing it out. I mean, the journey has been great.
Absolutely. And with Dipan, over the years, it's not just about market calls, etc. You come to know each other's family as Dipan's son. We have all been in touch. Had him work here for a brief period as well. So Dipan, it's been good, interacting with you over the last few years, and thanks so much for your wishes.
Now where's the party, right?
All right, well, let's get
I will throw the party for you guys.
Oh, tell us when we are going to be there, Deepan.
We are waiting to hear that.
Okay. Absolutely. All right, thanks so much for that. Well, we're almost getting into market opening. Mitesh, tell us what's your 9-10 call.
I'll go with a buy on Coal India. I think after a good correction, it's trying to move up. So in a market which is slightly weak, Coal India could outperform, and that's a buy with a stop at 228, targets of 240.
Okay, let's get to Nimesh now. He's standing by to give us the standout brokerage report of the day. Nimesh, what do you have?
Hi, Sonia. So today's standout is on SBI Life. Goldman Sachs has not only raised the target price to 1600 from 1440, but they've also added the stock to the conviction list. Now, Goldman expects the top line, that is AP, to grow 22% CAGR between FY23 and FY23 and FY25, and they expect VNB margins to further increase by 110 basis points on the back of better mix and operating leverage benefits. So that's the number. In fact, for the next couple of years, they expect CAGR to grow to 27% versus just 7% between FY18 to FY22. They see further catalysts for the stock to re-rate, largely on the back of three things. One, continued market share gain. Second, favorable interest rate trajectory. And three, across the board, consensus earnings upgrades. So on the back of that, they've raised the target price on SBI Life to 1600, and they've added the stock to high conviction list.
All right, Nimesh, thanks very much for that. So we'll keep an eye. SBI Life in focus. Now, the RBI revised those securitization norms. We put that to M&M Finance earlier, who said, well, for them at least it doesn't make too much of a difference. Abhishek is here, though, with what the impact could be in the broader space. Abhishek.
Well, Prashant, as you mentioned, RBI has made changes to the securitization guidelines. So loans have to be 3 months old and should not be of less than 365 days in terms of maturing, which cannot be securitized now. So loan duration has to be more than 365 days for NBFCs to securitize the loan with lenders. So this can have an impact on the securitization volume. The quality of loans that get securitized will improve, and shorter duration loans, especially in the category of microfinance and gold loans, that cannot be securitized now if they are under 365 days. So shorter tenure duration loans can get impacted from NBFCs to get securitized with banks. Back to you.
Okay, thanks a lot for that. But just keep in mind, M&M Financial told us that this is not the loans that they cater to, so M&M Finance will not get impacted. But just quickly onto the market. The opening is expected to be soft, down about 100 odd points. That's what the pre-opening rates have settled at. In terms of pressure points, there's technology stocks, Tech Mahindra, Infosys, HCL Tech are all down, TCS as well. So perhaps there could be some pressure coming in from there. The first tick on the index will come through in just about 2 seconds from now. There you have it. About 87 points gone on the Nifty. The Sensex down about 300 points or so. It's not so bad, actually, compared to what the SGX was suggesting. In fact, the mid-cap is almost in flat line now. So is the Bank Nifty. So just consolidating with a bit of a negative bias. Some of these metal stocks that rallied yesterday are coming in for profit-taking. So there's Hindalco, Tata Steel under pressure. IT, as I mentioned earlier, Infosys, HCL Tech, TCS, Tech Mahindra, all down about 1%. There is auto stocks that are under a bit of pressure. Hero MotoCorp, M&M are down about 1% odd. And then you have something like an ICICI Bank. So it's nothing alarming. In fact, the Nifty is now down just about 70 odd points, cut a bit of its losses. What's aiding it on the upside is Axis Bank. There is Indices Bank, there's BPCL, HDFC Life, SBI Life, all holding up in the green. Coal India as well is not too bad, up about half odd %. And something like a Cipla is also trending in the green. So yes, it's a weak opening, but down but not out, you'd have to say. a lot of individual stocks in the broader markets moving around. The advanced decline ratio, by the way, is even Stevens actually about 3:2 in favor of the advances as of now. So do keep that on your radar. Otherwise, yes, a weak opening, down about 80 odd points.
Well, that's right, Sonia. From the broader markets, well, a few of these stocks actually, I think, are reacting to that RBI changes that did come in. So we have a few of them that are under pressure. Manappuram, Muthoot, both of them are down closer around 2% apiece. So keep an eye out on that front. Nalco as well, yesterday had a good run. Well, that stock is seeing some bit of profit taking in trade today. Let's pull out some of these stocks that had large trades yesterday. You know, Rainbow, well, that one, in fact, should be up for you on the screen. It was a clean-out trade from CDC, and some notable names have come in. So that one's opened up mildly in the green. Go Fashion, well, there is a bit of an overhang still out there, but Sequoia went ahead and sold some part of their stake in it. They held closer around 10% stake, so that one as well has moved up marginally. And Gujarat Fluoro, into corporate loans, they'll actually get cleared out because of that sale of shares that we saw yesterday. So maybe we should pull up that one as well. Let's see whether or not Gujarat Fluoro is reacting. All those three mildly higher, but not such a bad start. We opened closer to around 18,600, and that's something that the SGX Nifty as well did indicate.
You know, yesterday's low is something which I think comes into focus, Nigel. So yesterday's low was 18,591, and we'll see if that gets tested again. But 0.5% cut is what we have right at the word go. By the way, the small cap index, after starting in an indecisive way, is up about 0.6%. The mid cap index is up, is flat as well, 0.16% at this point in time. All right, just a few other names before we go any further. Bajaj Consumer is up 4%. Let's have that up. It's a top traded and the top gainer as well. Suzlon is another 2% higher. It's coming up with volumes right now. Bank of India is up about 3%. J&K Bank, we just had the management talk to us. That's up 3%, 52.53. There is Tega Industries, which is up about 2.5%, 644 on Tega. Natco Pharma is another one which is up about 2.5%. JSW Energy is up about 2.25%. Astra Micro is another one which is up 3%. TCNS Brands, you know, that's jumped occasionally on the back of news that there perhaps is a potential M&A around the corner, or maybe, you know, there is a change in ownership, at least buzz and talk around that, but a potential change in ownership. About 605 on TCNS. On the downside, I mean, apart from what we've already mentioned, there is maybe Schaeffler, which we should put up. It's down 3.5%, well-traded, well-tracked name, and that is down about 3.5% right now. Otherwise, it's a lot of commodity names which are coming off, and there is tech as well, which is seeing some selling pressure, Infi, TCS, and some of the other larger cap names. The Nifty's got a cut of about 80 points, and we are holding there. Rahul Singh is joining us now. He's Chief Investment Officer Equities at Tata Mutual Fund to take some questions. Rahul, good to have you with us here. Thank you very much. So, I mean, the market has been grinding higher, Rahul. And usually we've seen this late into the year, before the end of the calendar year, trends don't change meaningfully, right? I mean, you don't start something new. What should we expect near to slightly medium term?
Yeah, I won't bet on that kind of seasonality just because past it has not happened. But yeah, you're right. I think what we are seeing is that the tug of war between good domestic fundamentals in terms of the cyclical recovery in various sectors and not so great global macros continues. And what we are seeing is just a culmination of that right now. I think Indian fundamentals, or the economic fundamentals in terms of the banking sector, capex cycle, etc., seems to be pulling its weight much more than what the global macros can pull it down with. But at the same time, you know, these are uncertain times in terms of which way the interest rates will go. I think market might be taking a call a bit too soon that we will get a pivot. Maybe not. Maybe the interest rates will stay higher for longer. So all those questions, I think, as we enter into 2023, in the first 3 to 6 months, it will become much clearer. So I won't be surprised if we stay in this kind of a market, a bit of a range-bound market with volatility, which is actually not a bad outcome, given that the global macros remain still very, very uncertain.
Okay, so range-bound market and global macros are uncertain, but that's not stopping a couple of sectors in our own market. Just take a look at the banks. Bank of Baroda, Bank of India, at fresh 52-week highs. In fact, Bank of India is now up almost 3.5%. Bank of Baroda sitting at a fresh 52-week high. It's more than doubled this year. So, you know, that's the question, right? Rahul, if we do see a range-bound move in the market, do you reckon that some of these sectors like banks could continue to outperform? The management of J&K Bank was very confident about a 16 to 18% loan growth. What's your pick of the pack here? And do you see more upsides?
Well, absolutely. I think in a range-bound market, there are much bigger and clearer opportunities for certain sectors and certain kind of stocks to do well. What we are clearly seeing is that value and GARP as a philosophy is tending to do better as we enter into this higher interest rate regime. So even if index remains flat, we will continue to see that outperformance continue. And secondly, like you mentioned about banks, the cyclical recovery in terms of the earnings, where we are seeing, you know, everything coming together nicely, whether it's credit growth, the NIMs going up and the credit costs coming down. You couldn't ask for more. And some of the banks are available at early to mid-cycle valuations, not their full valuations or not their full valuations in the last up cycle. So I think there is room to go. Obviously, you know, I can't comment on stocks, but as a sector, there is definitely valuation comfort, and there is also the earnings comfort over the next 1 to 2 years.
Rahul, what about the auto space? There were some positives that we were looking forward to. Some of them are playing out, but the index itself has been underperforming. If I take a look at the last few weeks, the second half of the year should look up. Demand is good. Input costs are cooling off. Supply side issues as well are getting resolved. Your pick of the pack?
So autos, yes, I think, you know, but it's not as clear as banks. You know, it's not moving in tandem. Let's face it that autos is not just one homogeneous sector. And let's start with that and then drill down into two-wheelers, four-wheelers, CVs and tractors. So the last two I mentioned, CVs and tractors, things are a little bit more clearer in terms of the structural drivers of the top-line growth. It is not as clear in the two-wheelers and the four-wheelers, and it becomes then a question of how much you are competing with EVs, what is the competition shaping up as, especially in four-wheelers. So it becomes a little bit of mixed and stock-specific call in two-wheelers and four-wheelers, whereas CVs and tractors, there seems to be more, let's say, macro tailwinds behind these two sectors. So there really you have to break down autos into multiple subparts, and it is not as homogeneous as an IT services or a banking sector would be.
What about some of these so-called trending sectors? I mean, I do know that there is some legitimate reason why, you know, these defense stocks, etc., are rallying. Orders have been coming in and there's a lot of focus from the government. But these are sectors that have this big move and then suddenly fizzle off. You think the best of the rally is done here in pockets like defense?
A large part of the re-rating is done, but the re-rating has been for good reasons and for real reasons. I mean, we are seeing that indigenization is not just a term, it is actually happening, and localization is actually happening. So there is focus. Some of the results of these efforts will take 3, 5, 7 years to show up in numbers. So to that extent, a large part of the undervaluation which was there in these stocks have played out. From here on now, it's a question of just tracking, making sure that each of these individual companies which have done well in the defense sector, how well they execute, whether the government policy sustains. I think it will, but we need to keep a track on that. And then the valuations will continue to be justified, and you will get returns in line with maybe the earnings growth. But as I mentioned, the large part of the re-rating or the realization that there is potential in this sector, that realization, when it comes there, the undervaluation goes away. I think that is something which is behind us now.
All right, Rahul, the other debate that's going on is, have these new age themes bottomed enough? While having a look at some of these themes, you have a few of them, a handful of them, 4, 5 of them that are listed. Some of them looking exciting?
These are all very, very different companies. Let's not club them together. And obviously, we are, the valuations have come down to levels where, they are probably only 2x the value which were there in terms of the pre-COVID valuation. So yes, there seems to be some amount of a reality check, and the valuation sensibilities have returned in this sector. So yes, we would look at it, but again, as I mentioned, we should not look at it as a pack. Each company has a very, very different business model, very different dynamics, very different ownerships in terms of the private equity. So we will have to take a call taking all these factors into account. And again, let's not forget that the interest rate scenario globally is also challenging for some of these stocks and the valuations to sustain. So it's a very complicated, a lot of moving parts in these stocks still, in my view.
Okay, by the way, the market is now falling further, so do keep an eye out on that. The Nifty is now down over 100 points. And remember, the 20-day moving average on the Nifty is 18,417. So we're holding on to that for now. So that seems to be a bit of a support for the market. But for now, it's not looking that great. Rahul, since it is the end of the year, as we head into December 15th, people start to sort of go on leave and there's festivities. Just wanted to wish you a very happy New Year in advance. And it is our 23rd anniversary as well here at CNBC-TV18. So what would your view be or wish be for all the retail investors who've watched you over the years? What's the kind of market outlook for the new year? What's the asset allocation strategy that you have?
Well, first of all, congratulations, and wish all of you and all the viewers also a happy New Year in advance. So my advice for next year would be to keep a focus on asset allocation between debt and equity. Debt is now also offering reasonable yields. Within equity, I think it has to be a combination of some of the dynamic asset allocation products we have, which will see you through this volatility of the next 6 to 9 months. But at the same time, I think there is alpha to be made in value funds. There is alpha to be made in some of the sector funds we talked about, banking and potentially infrastructure. So a good combination of asset allocation and alpha generating products or alpha generating ideas, I think, will be the name of the game next year. Thank you.
Okay, all right, Rahul, thanks so much for stopping by and filling us in with your thoughts, as well as thank you for your pleasant wishes as well. Well, let's move on. Vedanta, well, they have approved an interim dividend of close to around 17.5 rupees per share. With this, the total dividend payout is around 6,500 crores. The other talking point is that, Vedanta, well, there's been a big move in metal prices. So what's the outlook from here on? To understand that and more, we're joined with Mr. Sunil Dugal, the Group CEO of Vedanta. Hi, Mr. Dugal. Good morning. Thanks so much for joining in. Well, things are turning around in China with a bit of an unlock that's playing out. So that's good news for metal prices on the whole. But let's talk about the dividend aspect first. Year to date, you've already declared a huge dividend, 68 rupees 55 odd. Is there more in store? Because shareholders, they would love some more dividend. But in FY23, are you done or still more in store? Go ahead.
It's a board matter, and depending upon our cash position, we have been declaring the dividend. So depending on how the stocks will perform, how our business will perform, we will keep evaluating this option at the board level, and will come up the proposal to the board as required. But just to let you know, the business conditions are good. The metal prices even now are looking healthy. You must have also seen the upsurge in the prices from now on.
Okay, that's always good to hear. The business conditions are good. Mr. Dugal, good morning. Since a large dividend is being paid out already in FY23, wanted to understand what the impact of all of this would be on your debt. I think in September of this year, your debt was a little over 32,000 crores. Could it get higher over the next 6 to 12 months?
Well, we have declared to the market that in the next 3 years, at least, we deleverage our debt by around $4 billion. And you must have seen what we have done in the first few months of this year. So that is what the intention is, that we will reduce our debt at the parent level, and that is what the priority is. But with the healthy cash flows and the better margin and the metal prices looking up, this option will always be available with us.
Right, Mr. Dugal, hi, good morning, Prashant here. And that last thing, metal prices, right? I mean, that can swing fortunes so massively for you as it did earlier as well. So just give us a real sense, because I mean, you've got your fingers in pretty much all the metal pies, right? And oil as well. I mean, what's your sense? Have prices kind of bottomed out? Are we starting another? Is it possible if China reopening? I mean, there was a Reuters story which said that China is going to put out a plan tomorrow about reopening in January. Expectation was that that's going to only happen a few months down the line in 2023. So they're sort of quickening that process. Is that very supportive for metals? Which are the ones, according to you, which are placed in the best possible shape? Just some color.
So, 2-3 factors here. One, now the China is easing out the COVID norms. You must have seen, you must have heard also now. A lot of cities have eased out the norms. The economy is picking up. They have reduced the reserve requirement ratio of the banks, and they have given the direction that the real estate sector should be supported. They have given the stimulus in the month of October. We expect more stimulus to come. If you look at US, the inflations are easing out, and from that, I would expect that the Fed would not increase the interest rate from now. Also, in US, the inflation has eased out, and with this, you must have also seen in Europe, half of the aluminum capacity is cut, a quarter of the zinc capacity is cut. So the overall stocks of all the metals have come down. These are almost the record low level. With these fundamentals, you must also appreciate that the demand of the critical metals for decarbonization have not reduced at all. And you must have seen the growth of this coming up in all the geographies. And with these fundamentals strong, you must have seen of late, again, the rally has gone up as far as the metal price is concerned. But what is important for Vedanta is that we control our own internal factors, where we integrate our operations, especially aluminium, like zinc we have, and we remain in the lowest cost curve, and the margins remain healthy. But the way the market looks and the requirement of the critical metal remains high because of the decarbonization efforts of the world. I'm sure the metal Vedanta is dealing will always be seeing the rally from now on.
Okay. Mr. Dugal, I just wanted a few numbers if you can share with me. You said that you're looking to deleverage your debt by $4 billion over the next many years. But just in the next 1 year, how much could your debt come down by? What will your capex be? And any outlook on how much of that could be allocated towards dividend?
You see, I mean, with the healthy cash flow of the current year and the next year. So in Vedanta, we are doing all debottlenecking efforts and integrating our operations. And with the investment of $5 to $7 billion over the next 3 to 4 years in our capex, rising our oil and gas production, rising our steel production, rising our aluminium production, adding the value-added business, operationalization of the coal mine, raising the alumina capacity from 2 to 5 million ton, finishing the capacity in electro steel. I expect the revenues could go up to maybe $30 billion next year, and with the EBITDA margin of 30 to 35%, our EBITDA could be $10 to $12 billion. So with this strong position and healthy cash flow, we will have many options to pay the debt as well as service the requirement of the capex.
Yeah, Mr. Dugal, you're sounding quite optimistic, but it's a commodity after all, so things could swing around. But we take your point. You briefly mentioned electro steel. Now, some reports indicated you're looking at selling that asset. Can you clarify?
That option is not there at this point of time on our table.
You're denying that report that you want to hold on to electro steel, and in fact, you'll be expanding capacity out there as well. Is that correct?
Yes, that's right. So currently, we are busy increasing the capacity of electro steel by finishing the unfinished plant from 1.5 million ton to 3.5 million ton. So with 3.5 million ton at electro steel and 1 million ton at value-added business in Goa, the capacity will go to 4.5 million ton. But you must have also seen that we have taken action to integrate our operation by acquiring the mine, Bar Mill mine in Orissa.
Right.
So this gives us the option to increase our steel capacity from now on, and remain a player to reckon with in the market. And if we will stay in the steel market, we will definitely like to be among the top 5 players, not very far off from today. And would be very excited to raise the capacity, steel capacity, to beyond 10 million tons.
To 10 million tons, that's the longer term. So you don't want to sell electro steel. In fact, you want to ramp up capacity towards 10 million tons. We take that point. Let's talk about your zinc business then. There was some speculation earlier that maybe the international zinc business from Vedanta will be transferred to Hindustan Zinc. That's off the table, or is that still on the cards?
You see, there is a natural synergy between the two companies. So the international zinc business is located in the geography where the skill for the mining is available. Fundamentals of Hindustan Zinc have been so strong. The company very successfully transitioned to underground. We are the largest integrated metal producer in the world. The resources in Zinc International are even bigger than Hindustan Zinc. So if the Hindustan Zinc produces 1.2 million ton, there is no option that Zinc International should not produce more than 1 million ton of metal. So the exploring the opportunity where both the companies can complement each other. So we have been evaluating, but this is more like a board matter. I'll not be able to comment on this at this point of time.
Okay, we will end this discussion on that note. We've gone on for a pretty long time. Thanks a lot for joining in and speaking to CNBC-TV18. That's the word coming in from Vedanta. Let's slip into a quick break. It's the end of the year, so everyone's in travel mode. Let's talk to the management of IHCL Indian Hotels. Puneet Chatwal will be joining in to give us a demand sense of holidays, that fabulous wedding season. Later on, we'll also connect with Anil Singhvi of Sri Digvijay Cement and Rajesh Ravi of HDFC Securities for an outlook on the cement sector. Stay tuned.